Hello guys, okay, this is Ehis, and in today's class we are going to be talking about a very important concept in trading. All right, so now if you're along your trading journey, this is something that you will get to know about, and it's very, very important. The reason why it's so important is because you cannot really it's going to affect your trading in a whole lot of ways if you don't understand it. And if you understand it, you are going to be able to use it in a beneficial way for yourself as you trade along your trading journey. That's why it's so important, right? So and in this class today, at the end of this class, we stick around to the end. When we get by the end of this class, you'll be able to understand what this is, what currency correlation. The topic is currency correlation. Okay, so by the end of this class, you'll be able to understand what currency correlation is and exactly what it is and all the factors around it and how you can use it to consistently win in the Forex markets. All right, so guys, as we go on, if you find value in this video, please give me a like. All right, and then also subscribe to the channel and turn on notifications so that you can always be alerted when I put up these educational videos. These videos are for you to learn so that you can become better traders, right? So that's why we're dedicated to teaching traders on this channel how to trade Forex the proper way. All right, so let's get right into the video. Okay, so now the topic, like I said, is called currency correlation. So what is correlation? Okay, correlation basically is a statistical word. It's a statistical term in financial markets. It's a statistical term. Okay, basically what it is it's a relationship. It's a relationship. It measures the relationship between different assets, between different securities, different assets, or different things, right? So it depends on what you want to apply it to. But in this case, we're applying it to currency trades, currency, we're applying it in the financial market, we're applying it in the Forex market. Okay, we're applying to currency pairs, right? That's what we are doing with this. So it's a statistical term that measures the relationship between different assets or different pairs or different things. Okay, that's what correlation is about. But when we talk about currency correlation, we are talking about how this actually works for currency trading. All right, for currency trading, for Forex trading. All right, generally, that's what we're talking about. That's why this is very, very important. Okay, so now let's do something here. So correlation is a statistical term. I'll be doing a bit of writing on the screen so you can see what I'm doing. So correlation is a statistical term. It's a statistical term that measures the relationship between assets, between different assets, securities, etc. Right? So that's what correlation is all about. Okay. So now there are different types of correlation. So when we talk about correlation, what we are talking about is these assets we are measuring. We said we're measuring a relationship between different assets. So these assets we are measuring, are they working together or are they working opposite each other? All right. So when you are measuring correlation, it's a question of, are they going in the same direction or are they going in opposite direction? So that's why we talk about types of correlation. And we said types of correlation have to do with positive and negative correlation. So we have the first one is positive. And then we have the negative correlation. Negative. Okay. So now, when we say positive correlation, we're talking about assets that journey in the same direction, which means that when one asset is going in a positive direction, in an upward direction, the other one will be going in an upward direction too. That's when we are comparing two different assets or different currencies or different currency pairs. So we say that when one is going in an upward direction, the other one will be going in an upward direction as well, right? So when one is going in a downward direction, the other one goes in a downward direction as well. That means they have a positive correlation, which means that they go in the same direction. That is what we mean by positive correlation. Okay, they go in the same direction. All right. So now when we talk about negative correlation, we are talking about opposite directions. Opposite directions. So when one asset is going in an upward direction, the other one comes downwards. All right, goes in the downward direction. Okay, goes in a downward direction, right? So that's what we are talking about, positive and negative. Positive being that they go in the same direction. Positive is same direction. Negative is an opposite direction. Opposite direction. Okay, so the same direction and opposite direction. That's what we are talking about. That is what we're talking about when we say it's positive or is negative, right? So now let's look at some assets here and how they correlate. Let's look at some assets and how they correlate. So examples, okay? So an example is Euro USD. Euro USD is a very popular currency pair, okay? The reason it's very popular is because it's a currency pair that is very widely traded. Okay, it's actually the most widely traded currency pair in the world. The entire Forex market at 20+% on a daily basis of the entire $6.6 trillion in the market is accounted for by Euro USD. All right, so that's why Euro USD is very popular. So Euro USD has a positive correlation. First of all, we say examples, we'll say positive correlation. Positive correlation. So examples of positive correlation. So we say Euro USD against Euro USD versus GBP USD. GBP USD, right? So now when we talk about correlation, understand something. GBP USD. So understand something, guys. When we say correlation, positive or negative, there is perfect correlation, there is imperfect correlation. All right, we'll get to that. When we get to that, I'll explain that further. All right. So Euro USD versus USD, Euro USD versus AUD USD. So these are assets that are positively correlated, which means that when Euro USD is going in an upward direction, all right, is buying, GBP USD will be buying most of the time. GBP USD will be buying most of the time. When Euro USD is selling, all right, Euro USD is selling, GBP USD, AUD USD will be selling most of the time. All right, so these are some of those assets. Euro USD versus NZD USD. Okay, so these are very positively correlated currency pairs. Positively correlated, so they are very correlated to Euro USD. Then you have another group. You have GBP USD. You have AUD USD versus NZD USD. So these are very, very heavily correlated. Very heavily correlated. Then you have another one, USD CHF versus USD CAD. All right. So these are assets that are very positively correlated. Positively correlated. So they go in the same direction. That's the meaning of that. So whenever any of these assets is buying, you expect the other one to buy. Whenever any of this asset is selling, you expect the other one to sell. Okay, so that's the reason why they are positively correlated. They go in the same direction. All right, most of the time. They go in the same direction most of the time. All right, so that's the thing. Then we talk about negative. These are examples These are the most popular examples of positive correlated pairs, right? There are a few other ones, but these are the most popular ones you find. Okay, so let's talk about the negative correlated pairs. Negative correlation. Okay, so the negative, for negative correlation, you have GBP USD versus Euro GBP. So this Euro GBP and Euro GBP USD and Euro GBP are actually negatively correlated pairs, which means that when GBP USD is buying, moving upwards, Euro GBPs will be selling most of the time. Okay, will be selling most of the time, right? So that's for that. Then Euro USD versus USD CHF. That's a very important one. Euro USD versus USD CAD. So these are negatively correlated pairs, which means that every time you see a sell on Euro USD, most likely you will see a buy on USD CHF most of the time. You will see a buy on USD CHF most of the time. When you see a buy on Euro USD, you will see a sell on USD CAD most of the time. You see a buy on USD CAD most of the time. Okay, so these are negatively correlated pairs. Negatively correlated pairs. Negatively correlated pairs. Okay, so these are some of the most popular examples of positive and negatively correlated pairs. Okay, yes, these are many of the most examples of the positive and negatively correlated pairs. Okay, so now the next thing we're talking about is perfect and imperfect correlation. So when you notice, guys, all this time, I'm always saying most of the time. When one goes up, the other one comes down most of the time. When one goes up, the other one goes up most of the time. Why I say most of the time is because these correlations don't work that. Sometimes they are perfect, there's perfect correlation. Sometimes there's imperfect correlation, right? So there are several factors that affect correlation, whether correlation is perfect or imperfect. Sometimes you will see that every time Euro USD, for example, this one, sometimes when Euro USD is buying, USD CHF will sell. It will be so perfect. In fact, sometimes you'll see a signal for a buy on USD CHF, and you are seeing the same signal for a sell on USD CHF. On Euro USD buy, you are seeing sell on USD CHF at the same time perfectly. But sometimes it doesn't happen like that. Depending on what strategy you are using, sometimes you might even see a conflicting, you might even see something that, you might even see, your signal may even tell you buy, show you a buy on Euro USD and show you a buy on USD CHF at the same time. So, but basically, this is why understanding correlation is important. Even when the correlation is not perfect, you have it at the back of your mind that these two pairs cannot go in the same direction. They go against each other. So if they go against each other, that tells you that even if you don't see a perfect correlation at that time, you cannot place trades that means that these two go together, which means you cannot see a buy on Euro USD and take a buy on USD CHF at the same time, because at a point, what you are seeing that's showing you that they are going in the same direction with change, because there is a correlation. It's a negative one. It's a negative one. It's just like when you know that something is evil, you know, even if it does good things, the thing looks good, you know that this thing is not really good, right? So you know that this is the way this thing works, right? So even if you don't see a perfect correlation at that time, you understand that you already have this in your mind. You know that, oh, this is going to go in the same direction. This is not going to go in the same direction. They never go in the same direction. So I can never take a trade on Euro USD and take a buy trade on Euro USD and take a buy trade on USD CHF. It will not work eventually. One of them will lose, right? So if you're taking two trades and it's more like a guarantee that one of them will lose, what is the point of taking the trade? What's the point? So there's no point, all right? So perfect and imperfect. Perfect and imperfect correlation. Okay. So now, what are the factors that that causes this to happen? There are some factors that causes this kind of thing to happen. There are some factors that causes this kind of thing. Why is it that they are not perfectly correlated all the time? Factors. So why is it that they are not perfectly correlated all the time? The reason they are not perfectly correlated all the time are two things. In fact, the first thing you ask yourself is, why does correlation happen? Why does correlation happen? Correlation happens because of linkages, because of interdependencies among economies. We know that every time whatever is happening, whatever you see on the USD, on the US dollar currency, whatever you see on the US dollar currency, for example, we are on the DXY right now. This DXY is called the dollar index, the US dollar index, right? So now, if we go on the chart right now, you see how your US dollar index is moving. That is, there are several currency pairs. The major currencies do have their index like this. Okay, the minor ones do not have their indexes like this, but the major ones have their indexes like this, which means that you can actually go and trade just the index. You can decide to just trade the dollar, the US dollar, for a buy or a sell. Okay. Most brokers now provide that option. You can go and trade just on the dollar, trade on the GBP and all that, right? But for minor pairs, you're not going to see that tracked very much like that. Okay, they will always have to pair them with another currency like the US dollar. All right, so but why is it that currencies even correlate in the first place? They correlate because of interdependencies in economies. Okay, now when you have US dollar and Canadian dollar, for example, 75% of the export that the Canadian economy does in a year goes to the US. Okay, so the US accounts for 75% of Canadian exports. So imagine such a thing: 75% of the Canadian economy is dependent on the US. So what that means is that whatever is happening, what that means is that whatever is happening in the market, whatever is happening in the Canadian economy or the US economy are going to affect each other. Whatever is happening in the US economy is definitely going to affect the Canadian economy. So this is what you will see all the time. You see this. This is why correlations happen, right? Because of interdependencies between economies. All right. So now, also the reason why they correlate positively or negatively is the same thing. Is the same thing, right? You will see as we go on. You will understand. You will see more of these examples. Now, two factors that affect the reason why they correlate very perfectly. Number one, economic reasons. Economic factors. Okay, economic factors. When we talk about economic factors, we're talking about like I just mentioned, the interdependencies of economies. The interdependencies of economy. For example, when the Canadian economy, let's take the CAD economy, for example, Canadian economy. Canadian economy. So let's take the Canadian economy, for example. You will notice that the Canadian economy is very dependent on oil. Very dependent on oil. So if the Canadian economy is very dependent on oil, what does that mean? We know that during this pandemic, the price of oil has really been very volatile. All right? Dropped so heavily, it's trying to recover and all that. So many factors around the oil market. But definitely, when there was no pandemic and the US dollar and the Canadian economy, they had their relationship all the time. Now, when the price of oil that the Canadian economy is so dependent on begins to crash, what do you think is going to happen? That will affect the Canadian economy, which will shift the correlation balance. It will shift the correlation balance. So this is what we see. We're talking about Canadian economy, even the US economy, with all the lockdowns we had, businesses closing and all of that. So many of these, this is what's happening, even all the way down to Europe, in China, All of those things are very, very important. Okay, so that's one of the things that shifts the correlation balance and makes it a situation where you see a perfect correlation today and you don't see a perfect correlation tomorrow. Okay, so that's very, very important. Then number two is interest rates. Interest rates. Interest rates. So the interest rate regime, for example, we're still using the Canadian economy. The interest rate regime, for example, in the Canadian economy is very important. If the Canadian economy, if the Canadian Central Bank, the Bank of China, BOC, decides at the next market, at the next rate, the rate release to increase the rates or to decrease the rates, what that will do, and essentially, is that will cause a lot of things to happen. Okay, it will upset the economy, the economy as it is, as we know it today, as we know it right now. It will upset it for good or for bad, positively or negatively. So that also will shift the correlation equation that the Canadian currency has with either the US economy or any other economy that you can pair those with. All right. So these are the two factors that affect the correlation, whether perfect or imperfect, that makes it either perfect or imperfect. So we're talking about economic factors and we're talking about the interest rate regime. All right. So these are the two things that affect, two factors that affect the correlation, how it plays out perfectly or otherwise. So how do you, why is it important? Why is this important? Okay, like I said, when we were starting, I said this is a very important factor. So why is it important? The reason why it's important is that it helps, enhances your trading, enhances your ability to take profitable opportunities, utilize profitable opportunities in the market. Because if you do not know, this has been a challenge for many people actually. If you do not know that Euro USD and USD CHF have a near perfect opposite correlation, which means that you cannot buy Euro USD, you cannot buy Euro USD and buy Euro USD CHF at the same time. It's not possible. If you do that, you're going to get yourself burnt. One of those trades will be a losing trade. It's guaranteed, almost guaranteed. That one of those trades will be a losing trade. All right. How would you take a trade that you know is sort of guaranteed to lose? It doesn't make sense, right? But you will, that's what you will be doing when you do not understand correlation. You will be taking a trade that is guaranteed to lose. All right. So now that's the importance of currency correlation. So another thing with why this is important is you will know what to do. For example, the AUD and the AUD USD and NZD USD are almost perfectly correlated pairs as well. All right, because of the way the economies are intertwined, because of the kind of economies that they are, right? Because those two economies are very heavily dependent on commodities. So they are very close as well. So they are dependent on each other in very many ways. So if you know that one of them, if you know that they are perfectly correlated, you cannot buy one and sell the other, all right? You can't buy one and sell the other. So, and you may also not buy, because when you buy one and sell the other, you know that one of those trades will be a losing trade. But then another thing is, if you take both of them at the same time, it may also, for the purpose of diversification of your trading, of your trading pairs, it may also not be the smartest idea for you to buy AUD USD and buy NZD USD at the same time, right? Because if one is wrong, the other one will be wrong. If one is a losing trade, the other one will be a losing trade. So what you do is you take a AUD USD trade and you hold on, okay? Probably what you now do is when you are now in profit on that AUD trade, AUD USD trade, you now use NZD USD to increase your position. You can now use the NZD USD to increase your position, okay? You use the NZD USD to increase your position. So that's what we're saying there. You can use the NZD increase. You can now take another buy. Let's say you were in a buy trade on AUD USD. You now use NZD USD to enter a second position when the first position is in profit. right? Because you know they are going to do the same thing, right? So one is in profit, you enter the other one in order to increase your profitability, all right? So these are some of the ways you use correlation to your advantage, right? And then let's discuss something else, which has to do with commodity correlated pairs. Commodity correlated pairs. Okay, so now there are some economies that are very dependent on commodities. Okay, an example is card and oil. Card and oil. So the Canadian economy is very intertwined with the oil market, right? So whatever is happening in oil is going to affect the Canadian dollar. Okay, so you will discover that when the oil market is doing well, the cards as a currency pair will be doing well as well. All right, so now that is in your mind. If you are going to trade oil, you remember, or even if you were not trading oil, but you remember, once you see a strength in the oil market, you see that oil is buying heavily, it will tell you something about the Canadian dollar. It tells you that the Canadian dollar is most likely going to be getting strong because the price of oil is increasing. So what do you do at that time? What do you do at that time? You are looking to enter a trade like CAD JPY. When the oil market is doing well, you want to buy a currency like CAD JPY. You want to buy a currency like CAD JPY. You want to sell a currency like USD CAD. Why are you selling USD CAD? Oil is sold, is transacted in US dollar. But oil and US dollar have a negative relationship. Oil and US dollar have a negative relationship. So if oil and US dollar have a negative relationship, if oil is going up, the US dollar is going to be coming down. When oil is going up, the US dollar is going to be coming down, right? So, and we said before that whenever you see a currency pair, the first currency is what we call the base currency. The second one is called the quote currency or the counter currency. And then the reason why the base currency, in this case, the US dollar, is called the base currency is because it is the basis of the trade, the basis of the transaction. So if you want to sell, if you think that the US dollar is going to come down, you are going to sell USD CAD. All right. So that's why we are saying when we sell USD CAD, you're actually selling the dollar. You are actually selling the dollar. In this case, when you are buying the CAD JPY, you're actually buying the CAD. So whenever you see that an oil is doing well, which means oil price is appreciating, you already know that the Canadian currency is going to be appreciating as well. So what you do is that you come and you buy CAD JPY. So CAD JPY, because CAD, look at this CAD here, it will definitely have a positive correlation with oil. And then this will have a negative correlation with oil because the USD and commodities are actually fighting each other. Okay, the USD is always fighting commodities, not just oil, gold, silver. They are always in negative relationship with the US dollar. The US dollar has a negative relationship with commodities generally. Okay, so that's very important. Then the next one is we have AUD and gold. AUD and gold. So gold is one of the major commodities that the Australian economy is dependent on, in addition to iron ore and timber and a couple of other currencies, a couple of other commodities like that. But gold is a major one it's mined a lot in Australia. So whenever there is Australian dollar has a positive relationship with gold. So whenever you see a strength in gold is moving forward, moving upwards, just know that AUD is going to be appreciating. So at that time, what you're looking to do is to buy AUD USD. You are looking to buy AUD USD at that time. You're looking to buy AUD USD at that time. AUD USD at that time. You are looking to buy AUD USD at that time. Okay. So so basically AUD USD has AUD AUD has a positive correlation with gold, and AUD USD has a positive correlation with gold. So if gold is strengthening right now, go and check. Most of the time, you will see that AUD USD is also going upwards in the direction of gold. Okay, so just understand the purpose of the most important thing, guys, in all these things is understand the correlation so that you don't get into bad trades and wonder why. Oh, my analysis seems good. Why? What happened? Because correlation is so key when it comes to trading, guys. Correlation is so key. Okay, so the next one has to do with JPY, and gold. So JPY and gold. Why JPY and gold? Now, JPY is what you call is one of the reserve currencies in the world. It's a very stable currency. The JPY is a stable currency. Okay, so it's a very stable currency. It's one of the reserve currencies in the world, in addition to the US dollar and the euro. All right, the US dollar and the euro are what you call the reserve currencies of the world. And then JPY is one of that too. And the reason for that is the stability of the JPY, of the yen. All right, the Japanese yen. The stability of the yen is one of the reasons why it's also one of the major reserve currencies in the world. Okay, so the next thing is it's also known as a safe haven currency. Safe haven currency. Now, safe haven currency is basically a currency or an asset that investors go to invest in during times of economic uncertainty. So whenever there's economic uncertainty, investors go and invest in safe haven assets. A safe haven assets, an example of safe haven assets is commodities like gold. You will notice that during the pandemic, gold was buying. Gold went to all-time highs. Gold went to over $2,000. It went, and it did it in not more than probably a few weeks. Went so much, it took off and kept going. It kept going. It kept the largest buy trades we've seen in gold happened this year during the early times of the pandemic, right? Because whenever the economies of the world are uncertain, investors go to safe haven assets. And safe haven assets are like gold, basically commodities. And then a safe haven currency is the JPY because of the stability. All right. So this is one of the reasons why you find out that gold and JPY move in the same direction. Okay. So they are basically safe haven. When investors are buying gold, they are also piling their money into JPY because of stability. All right. So these are the things. Whenever they are looking at, oh, things are happening, the stock market is unstable, they move to JPY, they move to gold. Okay. So these are the things. That's also why you have a relationship, a positive relationship between gold and JPY. So whenever gold is appreciating, you know that you need to sell the USD JPY. So the selling of the USD JPY, remember, like I said before, that commodities have a negative relationship with the US dollar. Commodities generally have a negative relationship with the dollar. So whenever whenever gold is appreciating, you know that the JPY is going to appreciate as well. And when gold is appreciating, the dollar is going to depreciate. When gold moves up, dollar will come down. When gold moves up, the dollar will come down. When gold moves up, the dollar will come down. So if the dollar comes down, you want to sell the USD JPY. You want to sell the USD JPY when gold is going up. When gold is going up, you want to sell the USD JPY. So this is how correlation works. And then this is what, like I said, the most important thing is you may not see perfect correlations all the time, but you will see these correlations. But it may not be perfect. It may not be perfect all the time, but it will be perfect many times. Okay, so but basically understanding it and knowing these pairs, knowing these assets, these pairs that are positively or negatively correlated is very important. It doesn't matter whether they are positively or negatively correlated, or is it better to be positive or negative? That's not the point. The point is you understand the relationship, be it positive or negative, because all you need to do in the market, you are buying or selling. Okay, so since you're buying or selling, it really doesn't matter whether it's negative or positive. All that is important is that you understand. that is positive or negative. So understanding that now helps you to know when to when the relationship tells you to buy, or when the correlation relationship tells you to buy or sell. Okay, guys. So if you have any questions, right, you want me to, you think I didn't answer properly, or something you want to know more and all of that, so just drop a comment in the under this video, and I will respond to you, or I'll do a video that will address your concerns and all of that. All right, guys. So guys, if you found value in this video, kindly subscribe or kindly give me a like. All right, give me a like, give me a subscription, give me a comment in the give me a comment. All right, so I'll see you guys on the next video. All right, thank you so much for being part of this video. Thank you.